Hello, everybody. Welcome back to another episode of Not Financial Advice. We have a lot of things planned to talk about today, but the biggest news of the week, obviously, one of the biggest finance creators on YouTube, Meet Kevin, has launched his new venture. Sean is in the real estate space very intimately. Meet Kevin is been in the real estate space for a while. This entire new project called House Hack is about real estate. I know about it from an elementary perspective, so I'm happy we have Sean here today, who's really going to break down what the announcement was, what the deal is, and sort of what the opportunity sees for Kevin here. So, Sean, I guess we'll start with this. What
Yeah.
was your raw reaction to the announcement, and can you summarize what it kind of is?
Yeah, for sure. So first and foremost, I think we both probably can agree here. Congratulations to Kevin, right? For better, for worse, whether people love him or don't. I mean, the guy's out there hustling, trying to make things happen. He is obviously following the right path here. I sort of knew this was coming when he announced the Series 65. So Series 65 is what's known as a registered investment advisor licensing sort of requirement. But the reason you typically get it is not purely to give financial advice, actually, but to run a fund or to be able to run and manage money. That's sort of a requirement for a lot of folks. You have to be an RIA, and the firm needs to be an RIA as well to manage that money typically. So there were some little hints of what might be going on here, I think. And yeah, you know what? I think there's almost no better time to come out and try to do something like this. We're in a position where markets are starting to come down from a pricing perspective in real estate. We're seeing from that sort of macro echo perspective we always talk about on this channel. We're seeing interest rates are up and home prices are starting to get pressured down. If you're a cash buyer, you can really take advantage here. And that's sort of the crux of what Kevin is saying here, is that he believes that he has a systematic approach based on leveraging some technology. As he called out, it's still a real estate company, it's not a tech company, as well as his name and his marketing, as well as his unique systemized approach to doing this. I'm going to break down all these different pieces as how I do it, which I think is going to be very relatable how Kevin does it. When I launched, and I'm going to get into all these terms on it as we go here. When I launched my first REOC, it was after the, excuse me, the big crash in '08. I now have two REOCs that I own and manage myself. I think it was really interesting the way he sort of explained it. He explained his thesis on why and how he'll have an advantage. I'm going to speak to both sides of why I think he might, but also why he might not. And then I really want to call it the fact that there's so much negativity and hate around this guy every time he makes an announcement. And it really doesn't take much to take a step back and go, hey, good for him. If someone believes in him and wants to invest in him, go for it. And what I want to do is I want to take a full stop for a second and just say this. The reason I feel comfortable talking about this out loud, even though we call this not financial advice, I'm not going to be investing in his fund. I am not working with Kevin in any way. I don't know him. He certainly doesn't know me. We don't do deals together. We don't work together. We have no interactions together. So all of this is meant to be sort of my take on what I believe he's working towards. But what I want to also do is share with an audience a general understanding of what this next level real estate looks like, right? This isn't about mom and pop owning, a couple of rentals over their lifetime for some extra cash. What he's really described here is creating a large scale REOC, real estate operating company, that will eventually have the ability to be listed on a major stock exchange as an IPO. Thus creating some value for all early investors, himself included. That's his thesis. That's not my thesis. So the truth of this is, Amit texted you right away when I heard this news, and I said, well, hot damn, this is great for me. Because as someone who owns REOCs, one of the biggest challenges we face is getting a good valuation. What Kevin has actually done for folks like me is he's gone out and used essentially his marketing skills and capabilities and name, frankly, and he's going to be able to get a valuation on his business, which in turn gets me really like a free valuation on my business from a scale perspective. So I can go out if I wanted to raise money in the capital markets, not necessarily from private investors like he's doing. I now have a value I can sort of anchor towards and say, look, he's at this scale with his valuation. I'm at this scale. This should be my valuation,
Right.
Especially with more experience, a little bit more time doing this, etc. So,
And it makes sense for that to happen. So, for example,
yeah,
if Spotify bought a really big company for 150 million, if you're trying to sell a company to Spotify, you're like, well, do we offer more value than that 150 million did? And is that a benchmark we could potentially, or if you're convincing investors, hey, this is what a buyout looks like because in the past they've been willing to spend 150 million.
100%. If I suddenly tomorrow decided I wanted to raise capital and accelerate my progress, it would make it very easy for me to say, hey, look, here's someone in the space doing a capital raise at the same time. He's getting whatever, call it a 5 or 10x forward on revenue, I could go and say I should have the same forward on my revenue type of deal, right? So it's a great call out.
So what does House Hack do from your understanding?
Yeah, so he named. I watched the video in preparation for this, of course, and I want to be clear here that I am not pretending to be an expert in exactly what House Hack is. So what I want to describe to you is really the overall market of real estate operating companies as it is today. But we're going to start with this. What is the difference between an REOC, which most people really have probably never heard of, versus an REIT or a real estate investment trust, which most people have heard of because they use them to invest in the markets to get dividends. They typically have a good, strong return. So it's interesting. And I thought the way, again, just to give some credit where it's due, Kevin is an excellent marketer. That's not to say he's not good at other things, but spade a spade. Kevin's an excellent marketer. And he explained what he's doing in a way that was very much driven towards his audience, which are typically going to be very intelligent, personal finance focused investors, but not necessarily folks who are living and breathing in the realm of corporate real estate, large scale, institutional grade. People who are in that realm hear what he says and takes a different meaning, which is sort of my take on it. He said nothing that wasn't correct or wrong. It's just, I actually sort of will say he really did break it down in a way that felt very easy and very calm. So let me start here. So when you think about the term a real estate investment trust, an REIT, that is really more of a designation for tax purposes than an actual type of company. An REIT typically has to give a huge portion of all of its profit back to investors in the form of dividends, which means that REITs have trouble typically growing unless they continuously raise more outside capital because all of their profits go back to shareholders. That's why they make for great holdings in an investment portfolio. Of course, do your own research, but that's the reality of what it is, right? So I just want to call that out for a second. And typically 75% of gross income is what's going to be coming from real estate activities. This can be rents, this can be mortgage income, anything that sort of is directly related to real estate activities. And there are actual hard restrictions on these things. Now, additionally, as I already stated, 90% of all taxable income needs to be used as dividends for investors. And what's interesting about a REIT, and the reason I'm calling this out as a tax designation as opposed to a type of company, is a REIT has no double taxation. Now, this is the part where folks who live and breathe in the back end are going to understand what I mean, but I think it's important for anyone out there to know this anyways. In a sort of regular company, the company pays taxes and then you pay taxes also, right? When you get any kind of distributions, whether you're getting paid as an employee, as an owner, whatever the case might be. By having the REIT designation, the taxes are paid by the people who receive the dividends, not by the company itself. So it's just an important takeaway that this is one of the reasons why you'll see companies when they hit a certain size get that REIT designation. The other thing that's particularly interesting here, and a great point that gets missed a lot, is REITs have a minimum requirement for numbers of investors. And the idea here is that you really want to make sure there are no ultra dominant investors who control a huge piece of the company. They're getting unfair tax advantages, voting advantages, etc. So that's a REIT. Now, a real estate operating company is going to sound very similar, but the differences are on the restrictions, the taxes, and the liabilities associated with those restrictions, right? Liabilities in terms of losing that status. So when we think about an REOC, a real estate operating company, right, the general idea here is that they're going to have a business with its general purposes of existing to work in and around real estate, buying, rehabbing, renting, developing and selling, right? Putting out mortgages, in financing, anything you think of in the realm of real estate, managing properties, that can be in an REOC. But don't let the name fool you. An REOC can also be really anything. And I'll give you a real example. I pretty recently, it's not exactly top of mind, but I was sitting with my attorney recently and we filed for another REOC. And when it says, what are the activities of your company? What we literally put in is all legal activities. Because although the focus will be primarily on real estate, sometimes certain things will pop up and you want to be able to leverage quick access to it. There's no tax restriction. There's no shareholder restrictions, nothing like that. So it gives me the freedom to have my focus be where I want it, but have opportunistic opportunities to take other things on. There is no mandate whatsoever to pay dividends to anyone. And oftentimes you certainly won't for a long time until you really build up the business. However, an REOC is in fact liable for double taxation. You'll typically see this with any what's called C corporation, right? It's a designation of the type of corporation for tax purposes. And unlike the REIT, there is no mandate for the number of investors. So to give you a real example of this,
which allows him to raise from a lot of people.
Basically. Well, or even more simple than that, I could just own it myself. Mm-hmm. And when I go public, I'm the only owner until I take it public. So just a way to think about those differences. Now, what Kevin described in his video was that he's going to be operating what's known as an REOC. Makes a ton of sense to me, frankly. And what's really interesting here is when most people think about these kinds of operations, they're thinking about, and I'm going to use a name that's sort of on the same level of fame, although personally, this isn't what I would have used. I think like a Grant Cardone, right? The 10X guy. He very much is what is called a syndicator, where he goes out and forms a fund. That fund raises money, Amit, as you just said a second ago, raises funds from investors, then uses those funds to invest in real estate. Now, the reason why this is different is Kevin is suggesting an REOC with shares. So you will not be a partner in the company. You'll be an owner of the company in theory, right? Like you're going to own shares in this company. With a syndication, you are a limited partner. So you'll have certainly a percentage ownership and you'll get distributions based on that percentage, but you don't have any real voting capacity. You're not going to be involved in kind of day-to-day decisions. You're simply providing capital. And over some certain period of time, you get a return on that capital, and then your money comes back to you until the next one.
Right.
The goal here is not to go public. The goal is typically just to get a return on your money. And that's the big point here is there's REOCs and REITs. There's raising via shares to eventually go IPO as Kevin would like. And then there's syndications with the likes of big name producers. Now, the reality is behind the scenes, there's way bigger players out there than both of these guys. But for the sake of this conversation, they make for a good example of sort of the differentiation here and how they're going to go about their business. Now, what's also interesting, and I promise I'll stop talking in a minute.
No, good. This is great. This is great.
What I think is also interesting is in the way that we're thinking about how Kevin describes how he's going to find his deals, uniquely position himself in a way to get more deals, and also the types of competitors he named, I thought was really interesting. We'll touch on all those things in a second, but what I want to call it first and foremost is he is up against a lot more competitors than what he just named out there. Now, I want to, again, be fair to this guy. I don't think he was in any way trying to pretend like those are his only competitors, right? I think he genuinely is saying. So he will have a PPM or a private placement memorandum that's going to call out all the opportunities, the risks, the market conditions, the things that can go wrong. You're very familiar with this, of course.
I had to file those as well. Yep.
I had a feeling, right? Again, I've probably even seen a few. And I think the big call out here is that if you're thinking about investing in this, I have no opinion on it, by the way, whether someone does or doesn't. But make sure you really read and understand everything in there, because it's not just a question of whether you're investing in Kevin's company, but if there's other things you can invest in that might give a better return, a more experienced operating team, etc. So one of the things that he really called out that I thought was particularly interesting, and I'll be honest here, actually a bit shocking, but maybe in a good way, maybe not, is he called out like Zillow, Redfin, Roofstock. I think Mind you could include in there. But I also think about the large REITs like AMH, Invitation Homes, Starwood, which just actually combined with INVH, and many others. These are companies that own 50, 60, 70, 80 plus thousand single family rentals. Now, you also have the major players in the multifamily rentals. You have major players in industrial. You have major players in retail and office, et cetera, right? So there's a segment for everyone. From the sounds of what I understand about what Kevin's doing is he's really going to be focused on an REOC in the single family space. And just for anyone who's watching this, who's relatively new to real estate or doesn't live it day to day, when I say single family, or you hear me say residential, what that means is one unit, think like a single family home, up to 4 units. Okay. Anything that would fall under conventional financing, Fannie Mae, FHA for a standard buyer. And I'm going to talk to why that's a huge value in a second. Anything above that, 5 units plus or non-residential, is going to be commercial. When you come to commercial, you are playing with the big players. Okay. Like you better come hard and you better come with a lot of cash and you better come prepared to rock and roll. I'm in that space, but I'm the smallest little fish in the smallest little pond. So just to be fair, I am certainly not a player in that space, but I am a player in the space that he's in. And one of the advantages I have of having been doing this for a while is I have a number of ways I can source deals at very competitive rates. And I'm going to talk about how he said he's going to do it in a second, because I think it's really important. So I'm open to investing across the entire US, parts of Canada, as well as certain areas in Europe if it makes sense. I'm not currently doing that over there, but if it made sense, I would be willing to do it. I work with a number of different partners, and I'm not talking inside my company. I'm talking outside of my company to help me source and find deals, identify opportunities, get in on developments before other people get in on them.
And these
So
people would get some commission for finding you a deal, right?
they would either get a commission in terms of like a general sales commission, or we might have a structured deal where there's a piece of it that can come back, or a finder's fee, things like that.
Okay.
Typically, they're always licensed. I don't play any games, of course. It's all on the up and up. But like as an example, I might say, hey, look, actually, I think we might have even talked about this. It's coming up on the end of the year. I put an offer on a building yesterday, and then it ended up coming in lower than I thought. So I then called this gentleman I work with and said, hey, I want to pick up 5 to 10 single families in Arkansas in a specific area. Can you source 5 to 10 deals? I'd prefer new development. Through their connections, they'll go and call all the contractors and say, look, can you give us a deal if we buy 5 brand new builds that aren't done yet? Right. They'll tenant them. They'll ensure they're rehabbed properly. They'll take over property management for me right away. I simply provide the capital, then put title under my company name. So I'm getting in either pre-build, pre-rehab, or pre-repositioning. So the advantage that I have is I'm getting in a price advantageous way in a home that will be very desirable with property management ready to rock and roll. And oftentimes we do buy cash. So what Kevin said, which I thought was extremely interesting, and I want to be clear on why. I saw some comments that were super negative. And my general attitude is when I see people being super negative, it tells me one thing: they don't know what they're talking about and they don't do this. Okay. It's very easy to pretend that you do this, but it's very different to actually do it. What Kevin was saying was he was using a lot of terms like a wedge deal. A wedge deal is just a fancy way of saying that you're going to get in on a deal where you have some way of providing an increase in price or value of the property. I actually have a silly way that I think about it. I imagine a pie chart, sliced, and I just imagine putting another wedge of pie in there and expanding my pie to make it a little bit bigger. That's really not how other people look at it, but that's just, I like pie, right? So get some apple pie going, baby. So what he was saying was, because of his ability to source deals and market himself and his company, this was my take on it again, and I would love for him to jump on and explain it, frankly. What I foresee is, and what he said was, he can actually pay more than a normal REOC because he has a systematic approach to how he does it. He can take action very quickly because of leveraging technology to do his deals. And because he'll then have manual human underwriting, he can not only source them quickly, identify what to go after, and then quickly do a human review and know, is it a buy or not a buy? If this is your first time watching someone talk about launching this kind of a company, I bet you would have left that call crazy excited about, like, wow, he broke the code. He's doing everything correct. It's just nothing unique in this case. I do the same thing. I have countless systems in place that identify down to an exact T of what I'm looking at across the 15 or 20 MSAs that I'm in, major service area, where I might say, so I do a live stream once in a while on real estate. You actually join them sometimes, which I appreciate. And I was saying on the last one, like, one of the simplest ways to think about doing this is pick an area that you're interested in getting started in, figure out exactly what the parameters are. I want 3 beds and 2 baths. I want 1,700 square feet. I want it to be a multifamily, 2, 3, or 4 units. And then I want to be updated every time a new one hits the market. Well, take it a step further and add some logic to it. Okay, I want to be notified every time those properties sit on the market for more than 30 days. And I want to be notified when those markets that sit on for more than 30 days also have a price drop of more than 2%. Right. And as you stack more and more components on, you're just building an algorithm, right? And that algorithm is being done via different components of that search engine. So it doesn't have
search engine being like Zillow. Like,
it could be Zillow. It could be a custom one that you design on your own.
Okay.
So what's interesting is you can actually download a lot of data on this, and you can get direct MLS feeds too. So just what it's worth, if someone's a developer and they do that, that's really doable.
Got it.
What's really cool about it is, for cheap money, you can do all this, download it to an Excel file, bada bing, bada boom. The other thing I was explaining as part of this is I also have a hard go, no go. You either fit the math of what I deem to be a good deal or you don't. And if you don't, I'll never, ever think of that deal again. And if it does, we make an offer. It's that simple. There's no need to think about it. There's no need to underwrite it. There's no need to wonder if we're getting a good deal, because we can write offers quick. We can also get things locked up quick, which means no one else gets in and starts bidding wars or other issues like that. There's always contingency, so you can get out, et cetera, et cetera, et cetera. The reason I'm explaining all this is what Kevin said in his video was he's going to do all of that. And he didn't say how he's going to do it, but it might be an app or some piece of technology, but it's going to be that same thing. That's what the algorithm is going to ultimately look like, right? And we all have access to the same data. It's just a question of who's better at manipulating it and building out for the way we want it. But again, neither here nor there.
So you, to be clear, you do not believe there is, based on what you understand about the company, a technological advantage to finding the deals that someone can't do on their own. Really.
No, I'm not saying that. He might be able to hire out extremely talented developers who might have ways of manipulating the results or manipulating the data sets in a unique way to fit his style of wedge acquisition.
Okay.
So it can be differentiated. The question is, on this next point I'm going to call out, is it enough differentiation for what he then said next, which was that he would be willing to actually pay more than other buyers of properties.
Right.
So the question then is, does he have both efficiency and efficacy in his design to acquire deals that he then will have enough room through his systematic approach to doing this to add that extra value? And you start to see, the more we talk about this, the more it's like, he's obviously really thought about this. I know he's a smart dude. I know he knows real estate. And the riches are in the niches. And the deeper the niches, the better the riches, right? But there is a problem, is that we've seen this happen with Zillow. And we've seen this happen with
the iBuying, correct?
Correct, exactly, right? Where in order to scale to the size to get to an IPO, and a sizable IPO, you are going to need monster amounts of cash, right? And now I want to again call this out. I don't know exactly what he's trying to design here. So this is a bit of like education mixed with some guessing of what he's working on. He can easily reposition these homes and sell them and put that capital back into the company. He can hold them and rent them. He can use them and do massive lines of credits on assets against his company and buy more. So he has lots of strategies at play. I think what's interesting is going to be, he has found a way. I'm smiling again because I'm thinking how much this helps me personally. He has found a way to take a relatively boring wealth building business and make it actually seem cool or unique or some crazy differentiated thing. So I got to give credit where it's due. It's actually a brilliant approach to taking something that's been around for a long time and doing it in a better way. The problem, though, is his real competition is not actually, in my opinion, the Roof Stocks or the Redfins or the Zillows or the Open Doors. Open Doors getting killed right now, from what I understand as well. So he actually might be coming at a good time in terms of, they've already blown through cash to do what they had to do, and now he's coming at the end of it. But so am I, and so is everyone I know. And I can go and raise capital tomorrow based on reputation, probably as much, if not more, than him. And I don't mean
really. So because I was just about to follow up, it's like, but his differentiation is he's trying to raise 200 million. You think that you could do that?
Sure. The difference is going to be, I think he's trying to raise it through a massive fan base, of which a good percentage is probably accredited investors anyways.
Yes.
Whereas I'm going to go and look to 20 or 30 hedge funds, institutional investors, and try to raise a large amount from each. I don't want to do that. I do this so that I don't have to answer to other people.
Right.
That's the difference. I
don't. If your ambition
about,
was a Kevin ambition, that's the route you would go.
Exactly. If I wanted to try to go IPO and be a billionaire, I believe that I could do that. I have the confidence in myself and my abilities. I just don't have the ego that makes me want to get there, because that's not the life I'm trying to live. So I know there's gonna be lots of people who are like, you're jealous because you can't do it. Fine. You can believe that if you want. It doesn't bother me. I will not lose any sleep over it. What I do think is the unknown factor of the major players in this space. So take like an Invitation Homes, who owns 80,000 single families, or American Homes for Rent, which is, I want to say 40 to 50,000. American Homes does I'm not looking at anything on my screen, but I might be off by a little bit here, but I think American Homes does up around 1.2 to 5 billion in revenue. Invitation does probably just shy, if not right at about 2 billion. These are both companies with market caps of probably north of 20 billion, under 40 billion, in that range. I forget off the top of my head, but right about there. So these are not little startups. They could literally just go and buy Zillow. They could buy Open Door. I mean, their inventory, not the whole company. They could buy all that inventory, structure an entire deal to buy 10,000 at once and be done.
Right.
And the advantage they also have is what they're now doing. If I'm going too deep, by the way, stop me. But I love real estate, so I could talk all night on this.
I think people are going to enjoy this. This is good.
I hope so. And genuinely, like, I'm always happy to talk about this anytime with anyone. One of the things they've really seen the shift in these massive single family REITs is what they're now doing is they can't even acquire homes fast enough. Now they're actually buying massive land developments and putting up 2,000, 3,000, 4,000 homes at a time to put them under contract. That ability to have that massive systematic scale and systematic approach to operationalizing their business is huge. My gut tells me this is what Kevin's planning and probably going to do. I got to, again, like, this isn't meant to be like a rah for Kevin. I don't know the guy and I don't really watch his videos, but to be fair, what he's describing is an intelligent way to go about doing this. This is how I do it. This is how people I know who do it go about doing it. He just has the advantage of having a massive platform to market his idea, which is amazing. And frankly, probably realistically, the future of how a lot of businesses are going to get started and funded and scaled, if we're really being honest about it.
And so the efficacy of these deals, which is the profit he would make on the wedges, is the efficiency in the tech, right?
No, I don't think so. I think that it makes sense why you would say that, though. So I think the tech is merely the gas pedal. It's how fast can you move, it's how fast can you find the next deal. That's where the tech will help to accelerate it. The efficacy is going to be how fast can you get it under contract, get it in-house, and get a contractor on site to start doing the work.
And that's a question of like just operational execution of a team getting it done.
That's the operational efficiency that goes along with the efficacy of the deal making. Exactly right. You nailed that literally head on. And that's the challenge for all these companies, is once you hit a certain scale, finding solid, cost-effective ways to maintain, manage, rehab, and source materials. That's where it gets challenging. But again, this is where if he gets to a big enough point quick enough, and assuming he raises quite a bit of money, he'll have that scale to do it at a national level. I mean, like if you think about all the things we've said so far, we've talked for a while, or I've really talked for a while, I guess, is you could see a scenario, Amit, where one of these other players just simply buys House Hack.
Yeah.
For a huge sum of money. And the beauty of this space is you don't have to do a lot of guessing as far as what someone would buy your company for, right? If you have 1,000 homes at an average value of 200,000 a piece, there's your valuation.
Yeah.
Right. I mean, if you're selling it for assets, if you're selling it for revenue, you can go and look at what the publicly traded REITs are trading at compared to the privately traded but SEC registered REITs. And it's very easy to come up with that model. And same for REOCs. Like, a lot of people don't realize this term, real estate operating company. This is like a history lesson I never thought I'd be giving out loud, by the way. And REOC is not a new concept. This goes back to the 1940s with the Hilton hotels. Those were REOCs way back when. And the idea being that, like, look, we want to keep expanding, not just collect and pay out rents. And that's why an REOC is sort of, I don't want anyone to take this overly serious, but if I was going to give you an analogy, you know, an REOC is growth versus an REIT is value, right? In terms of, if you think about another type of stock, right? It doesn't mean you get the crazy tech valuations, but you also don't get the drops usually as well. Like, I can tell you right now, within minutes, what my vacancy rate is, how many tenants I have, how much I collect per month, what my average maintenance costs are. Like, these are easy numbers to calculate. It's an easy business to manage, but it's a very hard business to get into at scale. Everyone and their mother can get into an FHA, a conventional Fannie Freddie mortgage to do real estate investing and get their first house hack themselves, ironically, house hack, right? But getting to the next level, and then the level beyond that, is really tough. Like, typically, just for anyone who's wondering, like, hey, can I do this myself? The average investor using a regular bank or lender or credit union, they will either have a 4 mortgage restriction, or some will offer a 10 mortgage limit of what you can have. So Wells Fargo might say, hey, you can have 4 properties with a mortgage. Maybe it's your personal residence, and 3 rental properties, as long as they're 4 units or smaller. A credit union might say, hey, look, we're willing to go to 10, but 10's the cap. Once you get past that number, now you have to start structuring DSCR loans, portfolio loans, wrap loans, bridge loan, all kinds of different kinds of things here. We don't have to go into all those details, but I just want to call it out. This is why when you think about scaling a big real estate company, whether it's a REIT or an REOC, is very, very interesting in terms of building a lot of wealth, because at some point you sort of don't really have competition. I don't want to say the name of the company because I don't know if they'd want me to, but there was a publicly traded REIT that myself and a business partner had located that was way undervalued. The numbers are so obvious you could look quickly. We started buying up heavy into this
What do you
company.
mean buying? You mean like the shares?
We were acquiring shares at a pace where we were going to force ourselves onto the board. And we ended up just sending a note to the CEO that, like, hey, you need to think about getting acquired, because the value of there was an arbitrage period of what the market was saying the company was worth was not even close to just the value of their paid off real estate. So long story short, they actually got acquired by one of the huge REITs. We made out like absolute monsters. And my point in saying this is that happens on the public market rarely, but it happens in the private market all the time. So if I was going to be an investor in Kevin's thing, and again, I wouldn't be because I do my own thing, just so everyone knows, it's no negative connotation here. It's also not an endorsement either. I would really be asking myself, like, what are the exit strategies? He says IPO, but it could also be acquisition. It could also be lots of things. Maybe it gets turned into a REIT and you collect dividends. I don't know.
Go ahead.
Sorry, go ahead. I could use a break.
You got it.
Water.
I was going to ask another question, but you got it.
All right, so let me just to finish the thought too. The term IPO, I know anyone who watches you is going to know what an IPO is.
Initial public offering.
But the interesting thing people don't understand is, and this is all public information, if you go to Google and you type in either NYSE or NASDAQ listing requirements, you have different levels of how to go IPO. You could be a major, like you could be the Facebook IPO, which is massive global, and you're going to do like a full-blown top-tier massive IPO.
Goldman Sachs, Morgan Stanley.
Bingo. You're using major investment banks. You're going big time. Or you could also do an IPO in what's called like the capital markets, which is just a way to get your shares on an exchange. You're going to raise a bit of money, but generally it's a smaller company, and the listing requirements are actually less. So depending on which level of IPO you want, the requirements to go IPO are actually different. And within those requirements, there's asset-based requirements, or a revenue-based requirement, or a shareholder value-based. So it's really a matrix of different ways to do this. So when people are mocking anyone, this isn't about Kevin. When people mock anyone and they say, I want to go big, I want to do an IPO, it's very easy to mock, but it doesn't necessarily take a lot to do it, right? That's why there's so many companies that go public, in the tech space, of course, that go public that are like, basically pre-profit, or some are even pre-revenue, if we're being honest, right? I mean, really, really not great buys sometimes. But that's why I think, just to take a moment from this, if you think what he's doing is stupid and you would never give him a nickel, and you hate his channel, you hate everything he's doing, I would ask you why you're still talking about the guy. But even to take it a step further, then fine, go out and start doing it yourself, buy some properties. It works. It's not hard. I mean, it's super easy for anyone to do it. So I'm going to take a sip of water, because as you can tell, Amit, man, I love.
That was a good 39 minutes of you just going at it. I love it.
Yeah, I love this stuff. All day I could talk about it. I mean, listen, Kevin, you're welcome to offer me a job as your COO. You let me know.
So one of the things I was confused about is this: each share costs $1. It's like 1-to-1.
Yeah.
Typically in a company, the founder buys their shares at a fundamentally lower level because they're taking on more risk. Is this something that's like good if you're investing, that the guy's getting at the same price as me, or is a REOC totally different than a traditional tech company?
I both think that he was being honest, but a little bit opaque in the explanation. I'll explain. Of course, you're right. When you found your company, you might start off with, I'm just going to use a random number, 1 million shares, and you're going to give yourself 1 million shares. And you're going
to pay 0.0001 cents for them, big $10.
Exactly. There's some par value associated to it. It's typically basically nothing, and the company's worth $5 the day you form it.
Yeah.
When your next round comes in and you have a valuation, now your shares are worth that value amount per share. Then you have another round. And typically they'll be either all the same types of share, common stock, or maybe it's preferred stock, or maybe it's founder shares. Okay. And we're going to talk about this in a second, because this is important. What Kevin, as I understand it, is saying is he's not taking any advantage on the round or when money's being raised. If you come in at a $5 million valuation, his money is getting a $5 million valuation, which is pretty interesting. To be my take is, I don't think that I'd really care that much whether I want him to be incented to make my money go 1,000x.
Yeah.
So whether he is 1-for-1 with me or 100-to-1 with me is a little bit to me not that important. But I get the feeling his fan base will see the value in this, and maybe this is enough to get them to invest. So again, credit where it's due as a marketer. I think he's done a good job explaining it. But he did go on to mention, though, that he will retain voting rights on shares and no one else will. Mm-hmm. So although you're in theory buying in at a 1-to-1 dollar ratio, they are certainly not the same value in terms of a stakeholder perspective, right? You're both shareholders of the same dollar amount, but your stakeholder perspective is that you don't have a say and he does. Right. Now, before anyone goes crazy or blasts me or anyone else, this is actually super common. A lot of times the reason we do this is because a founder, especially in the beginning stages, has a vision and a direction and needs to be able to execute on that direction and doesn't want shareholders coming in to try to disrupt the company or the path it's on. If that's something that bothers you, you need to run away and never, ever give $1 to a company that does that. If it's something that doesn't bother you because you believe in the vision, hey, then that's another positive for you to make. I did think that was interesting, Amit. I thought it was a very interesting way to bring it out there. I think there's going to be an ancillary. I think something's going to happen from what Kevin's doing here. I think other people who are trying to raise money are going to have to use this. And actually what you did, I'm going to be fair, you really have been doing this too, is I think people are going to realize that if you are not engaging with your shareholders and making sure they feel equally valued and part of the process, I think it's going to be harder and harder for traditional businesses to raise money.
So I was just about to piggyback off this question. Yeah, Meet Kevin, you said you could theoretically raise $200 million, and I believe you when you say that, given I know your experience and where you're in. Meet Kevin has social capital. There is zero reason to me why he can't go to Ross Gerber, and Ross Gerber, that he's obviously very friendly with, and Ross, I mean, get drunk for God's sakes together, and Ross Gerber can't, who manages 1.5 billion, can go to a couple of his friends. 200 million. I mean, that's nothing if you're playing in Ross Gerber's world. It seems like it would have been extremely less risky just from a personal brand reputation standpoint and being public with it, but just getting the money from those types of institutional investors. And he's a good enough negotiator, in my opinion, or just speaker that he could convince those people. Like, look what I did on YouTube. I got 2 million people to care about. You think I can't take your money? Like, there could, but he chose to go to his audience. Do you think there's any strategy there from a business sense, especially when you're putting accredited investors who have disposable income, but they're still at risk versus an institution? If they lose 200 million, it doesn't really matter that much in the grand scheme of things versus someone who loses 50 grand. What was the logic, in your opinion, to go into his audience? And real quick, one caveat here. I went to my audience because with 14,000 subscribers, it is very difficult to go to, institutions. Now, granted, we raised 200K from private angels and 100K from just my audience, from $500, $600 checks. But I don't think I have the social capital that Kevin does. And I don't have the connections like a Ross Gerber that Kevin does that he could get that money. So why do you think he went to his fan base?
Totally fair. I think that Kevin has yet to prove that he can do this. And I think the valuation and percentage of his company he'd have to give up to institutional investors and private investors, and not private, larger scale private investors would be higher. So he'd have to give away more of his company. There would be people who want to be on the board. They're going to want to have a say in how this company is run. That's my opinion on this, because there's a lot of places I can already put my money. And also the positive here is, I think this might be a much easier way to do it for him. He can probably raise a ton of money really quickly and then go and raise another round.
It would just be easier to convince 100,000 people versus a couple of
to your point, not many people have the ability to put out a video and have 500,000 people see it across multiple types of devices and platforms instantaneously. Yeah. So I think there is something in there to take away. So if I could raise capital by putting out a 30-minute video versus visiting with 40 investment bankers and putting together 40-page docs for each one and talking about my, I think that there is a combination of both ease of access, ability to raise quickly, and just in general, the stress load that goes into it. Plus, it sort of speaks to the image he is deviated from, but still been close enough to the line of being like the friendly Meet Kevin who's here to help people learn how to be, whatever his channel sort of pushes on them, right? Good or bad, however you feel about that, that's his go to market, and I think this sort of sticks true to it. And it's funny, I did see a lot of people who really were like a lot of very negative, very vile comments.
No.
But the ones that stand out to me all the time are like, well, if he really cared, it wouldn't be an accredited investor. This is like the oldest tune in the book. I've been listening to this thing forever. It sounds like it's so unfair, but the problem is it's because as a percentage of income, you should be putting so little of your money into these organizations that someone who doesn't have at least $1 million, you're by definition, you're putting too much of your net worth into an illiquid company. It's not a question of whether or not you can get growth or not. It's a question of like, what happens if you do this 3, 4, 5? Because an accredited investor doesn't make one investment. There are 30 investments at, a minimum amount each. So you have to be diversified the same way you are with your portfolio. So I'm just calling it out because that's an area everyone who raises money gets a lot of negative attention for. And the truth is, as much as people love to be like, well, if I was in Facebook, I'd be a billionaire. You would never have had the opportunity to get into Facebook because it wasn't open to anyone. So like you got, it's these kinds of things where I'm like, just focus on what the guy's doing and not on with the people who hate him or despise him or whatever.
A lot of it's also legal. I mean, like
of course,
you're just not allowed to raise from non-accredited. So it's like, what are you supposed to do at that point?
Yep, without restrictions, without everything else, you're absolutely correct.
Okay,
so I don't know. It's interesting.
I guess last. So overall, you think it is an idea that has potential. You think there is a founder who obviously has a big work ethic. You just think there is competition in this space, and if he's able to leverage efficiency for efficacy, there is a market opportunity here. That
let me give some of the perceived negatives, not about Kevin specifically, but about what people who don't know about the rest of the industry because they don't have time to interact with it. People love to say like, well, look at Adam Newman with getting this money from A16. Well, first of all, Adam's not investing in single family homes. He's talking about buying massive apartment complexes with hundreds of units apiece, creating efficiencies within that and developing WeWork style living experience. Now, I've already expressed to you and to this channel how I feel about that, but there's a very, very different situation than looking for wedge deals that you're going to pay more than everyone else for to try to find efficacy and efficiency in those deals. That's not a mark on Kevin. It's just to compare the two. They're so far apart. They're uncomparable. It's not even apples to oranges. It's like apples to automobiles. It's just not comparable. The other thing that stands out to me, and I think that this can come from, you just made the comment a minute ago, because of Kevin's work ethic.
Yep.
Compared to who? Like, who do you know that's running 2, 3, 4, 50,000 unit REOCs? Like, what's their work ethic look like? Are they flying all over the world 3 times a day? Are they like, my point isn't to criticize your comment. My point is, we don't really know who he's up against. Those people work a lot too. I work probably 90 to 100 hours a week easily. So like there's no doubt the guy's a hustler and a hard worker. My only fear, and this is not to be a negative because again, I'm neither endorsing nor saying I'm against it. The only thing that concerns me is to take a company from nothing to IPO and raise capital while you're doing it requires a level of focus on the end goal that is massive. And oftentimes the end goal needs to be not an IPO, but I would like to have 100,000 units, a valuation of, I don't know, pick a number, right? 10 billion, 30 billion, whatever. And the IPO is just part of the IPO is a capital process, not a finish line.
Yeah.
So my fear, and I know we've discussed different pieces of this too, like my fear is that you don't want to chase an exit. You want to chase maximizing growth at scale, which will lead to an exit naturally.
Right.
But all that being said, I think for the real estate business, especially for people in the age group that really follow Kevin, I think this is phenomenal. I think this is a great chance to really understand that real estate is more than just renting an apartment or buying a house to live in. Real estate is a huge industry with lots of different ways in it. And if someone's watching this and they're like, well, if I could get into a rental property, that'd be great, but I don't have any money. It's not fair. Well, I mean, I don't know what to tell you. You certainly can. You need 3.5% to put down on an FHA property. You can get a 4-unit, live in one of them, collect rent on the other 3 for 3.5% down. Boom.
You just got to be willing to do the work, and that's
have to be willing to do the work. And the other thing people are not willing to do is they say, well, I don't want to move. I want to. It's like, listen, I mean, okay, you have goals, and you're either going to work towards your goals or you're not. You have to adjust your goals based on the reality of where you live. I can show you a 2-family down the street for me that's for $900K that will never cash flow but will appreciate. But if we go and drive, let's call it 45 minutes west of where I live, I can show you a 10-unit apartment building for $400K that cash flows 3 days after you buy it. You just have to be willing to move the concentric circles of what you're willing to get into and where you're willing to manage. So anyways, I guess I'll sum it up like this. In a world of really cool tech startups that are trying to crack the code and do things differently, Audio being one of them, it's also interesting to see an attempt to reconfigure traditional businesses like real estate and rentals. And, just like I'd love to see more pizza shops open up and more local retail stores open up and unique ways to do that as well. So all in all, I think it's a pretty exciting thing. I think it speaks to the macroeconomic world that we're in. I think there's opportunities here. And I think that's the key takeaway is if you're interested in investing in Kevin's thing, but you can't, you can still invest in yourself and buy REITs. You can still invest in yourself and buy a property that needs work, and you're going to do the work yourself and then rent out a couple of rooms and house hack it yourself. I'm going to make a final comment, though, and then I'll kick it back to you. What do you think about the name?
House hack. I was kind of indifferent to it. I didn't, I don't know. I mean, I know house hacking is a concept, right?
Yep. Been around a long time.
The fact that you got the trademark on that is pretty cool.
I can't believe that. I mean, I thought Bigger Pockets owned that.
Yeah. No, I was like, it's a cool name. Seems all right. I thought he was hyping it up and there was going to be a bunch of AI and fancy tech. And so when I got the announcement, I was a little bit shocked. I was like, oh, this is all real estate. This has nothing to do with AI or tech. Now there is software involved, but it's not like that. So I was just like, okay, so it's a real estate company. And
dude, you know what's funny is like I cannot tell you how happy I was to hear that. Finally, we don't have to slap the word AI on something just to trick people into thinking it's some unique thing. It's just math. So I also was very happy to see that you're finding a way to rebuild the whale in a slightly more efficient way potentially, and investors will reap a reward if you accomplish that mission. If not, they lose their money. It's a lot of pressure. It's probably a lot of stress. And, it's going to be interesting, I think, for a lot of folks to see how this actually works and whether or not he can do it. But I also think it's a great way for a lot of people to learn how this works who have never had the experience before. So with that, I mean, for this business, my gosh, this is, I mean, I'm pumped. I can't wait for this thing to get going so I can go and call 15 bankers and be like, see, now add a 0 to what you say I'm worth.
I love it.
I love it.
All right. Sounds good, Sean. Thank you for taking your hard-earned time and really breaking it. I think people are going to appreciate just actually understanding it from your perspective. So it means a lot.
Yeah. Just people got to keep smiling and keep staying positive, and they'll find a way to do whatever they want to do. That's the end of the day.
I agree. At the end of the day, you're either trying and maybe failing, but if you're not trying and not doing anything, it's hard to
totally agree
to matter. So, all right. We'll see you guys next week on Not Financial Advice.
See you, everybody.